Hello traders, this is John Kicklighter, Chief Strategist for DailyFX.com. Recently we've been talking a lot about the Fed and its implications with the new taper shift, what it means for markets, what it means for the US dollar, what it means for risk trends, and a lot of other factors. I think we move back and forth in terms of the very broad implications that this can have. But I want to use this strategy video today to really focus our discussion on how to measure it and how it can carry meaningful implications for the US dollar alone. I think the measurement part we have overlooked a lot, or I've glossed over a little bit, and it still eludes some people. So we'll take a really close look at how I'm looking at this and how I'm looking at different signals from the market to see how the sentiment amongst investors is shifting alongside the Fed's decision to ease back on the monetary stimulus approach. All right, so the first thing, and the whole reason that this came about was because we had a lot of speculation in how the FOMC minutes that we had this past session could impact the equity markets or impact the US dollar. Now, looking at that particular statement, it was indeed quite remarkable. We did have a number of comments that were not just supportive of the taper regime that we've adopted back on December 18th, but it suggested that most are actually supportive of a consistent wind down. Moreover, there is a growing concern about the connections between financial stability and the influence that QE has offered. So that's that cost aspect that would be more of a driver towards taper than any of the economic growth or inflation figures, because inflation is non-existent and growth still has a long way before it can fully recover. But as a central bank, they can't simply just stay at these exceptionally aggressive stimulus levels simply through the unforeseen future. So it is a change that we have certainly seen in tone, but some people were projecting, I guess, that this would be a little bit more market moving than it actually had proven. As you can see, it wasn't necessarily that market moving. The US dollar, while it did not advance in a very aggressive manner. The S&P 500 actually closed up on the day. So what are we measuring here? Is the Fed just simply not that market moving? Do people not care about the taper? Has it simply been pushed to the backdrop? No, it's still very important. And as we were talking about back on December 18th, when we actually did have that taper, back then it was an issue of liquidity, actually. Liquidity was exceptionally low going into the year end. Most investors are not going to make major changes in their portfolios because they only have 3 active trading days to do it, and subsequently it would be very difficult to make any kind of subsequent changes from there. Now we are back into full liquidity, or at least it's getting up to that in 2014, and those conditions are more conducive to actually see these themes play out. We have not seen the end of the influence of the Fed's taper or the Fed's monetary policy bearings in general going forward. Now, the one thing that would be a discount to what we had this past session, the FOMC minutes, was it simply is a confirmation of what we had already learned on December 18th. So not necessarily a major driver. And we're going to look at these two particular bearings and other aspects of this very important theme to see why these might not necessarily be, the dollar surging and the S&P 500 dropping off, because it taps different things. Okay. So when we talk about monetary policy, I think one of the and especially from the Fed, the first place we often look is this relationship here, the S&P 500 and the US dollar. This comparison, this particular chart actually shows a lot of things. One that we have, as you can see, I highlighted here, the start of any kind of monetary policy discussion, change in that theme back in early May. Then on June 19th or 18th, the Bernanke actually decided to give with that statement a view or a timetable for when they could eventually get to the taper and when they could actually end taper. That was a very momentous time. Then, of course, we had the September 18th Fed decision, which the taper is fully priced in, but it was not realized. All right, a big continuation for the U.S. dollar to the downside, and subsequently the the S&P 500 actually pulled back, which was unusual. We talked about that when back then. And then, of course, we have December 18th when the taper was announced. All right, so these are a lot of very important events in this scheme. But I think what's we need to really pay attention to is that they're both moving up at the same time. All right. One is a market that is fully involved with risk and higher yields and consistency and low volatility. That's the S&P 500. The U.S. dollar is a safe haven. It does do well when yields are rising, but market-based yields and benchmark rates compared to other counterparts. All right. It does also exceptionally well when volatility picks up and fear is a catalyst. So they should not necessarily be moving in the same direction. All right, historically, it is more often a negative correlation between the two of them than positive. All right, so this is where we often look, and this is where a lot of the confusion comes from because we see this relationship, we see relatively moderate responses to very meaningful event risk, some contradictory responses, and some initial in-line expectations. So it spans the spectrum, and a lot of our view gets lost or distorted when we look at just something like this. Well, let's look at something a little bit more connected and grounded when we're talking about monetary policy. This is something that did play out very keenly this past session. This is the 10-year Treasury bond yield and the 2-year Treasury bond yield. All right, so we started to talk about the possibility of changing that monetary policy bearing from the Fed. Look what happens. Both start moving higher. All right. We come up to the June decision in which they are starting to talk about the possibility of taper. Continuation. All right. This is both an increase in interest rates on the expectation that the economy is improving, and this is a reflection of what the Fed is doing, but it's also an assumption that the Fed is going to start to throttle back on their purchases of treasuries. Now, for those that don't know, treasury prices and yields move inversely. So if the Fed is going to buy less treasuries, the value of the treasury drops, and the yield subsequently rises. Okay, so this is moving exactly as would be expected. And then subsequently September 18th, disappointing because the taper that was priced in was not occurring. Those treasury yields drop. And to December 18th, you had a big rally in the 2-year yield, though the 10-year was relatively restrained. What's up with that? All right, and you can also see that this with these FOMC minutes, big increase in the 2-year yield, relative restraint from the 10-year. The 10-year has already seen some more significant appreciation. I put the 2-year on the right-hand axis here, so it kind of distorts the scale. This is a little bit more volatile, but there is also a view that we look at the 2-year because most likely within the 2-year scheme, the Fed is going to hike rates. All right, we see in their forecasts, actually from the Fed themselves, in their updated forecast that most policy officials think that this is the first rate hike comes within 2015. So it's covered within this scale. All right, it has to price that in. So you can see a comparison here of how these operate. 2 and 10-year yields are very worthwhile to watch as measures for the taper, the market's taper expectations. And as this continues to increase, we're going to see that the more dramatic influences on the capital markets and on the U.S. dollar will start to pick up as well. All right, so this is a very objective measuring tool, but it's the kind of tool that will tell you what's underneath the surface. All right, and rather than just presuming that this isn't important because it hasn't moved the dollar or hasn't driven the S&P 500, we can actually start to see some of these underlying moves. Okay, and if we get a little bit further out, we'll start talking about the 2-10 spread, the differential between the 2 and 10-year yield, but I think we're a little bit too early in the conversation for that, so we'll save that for another day. But where we start to really see the market's interest, all right, most traders will start to pay attention and they start to deem the Fed taper and its stimulus program as market-worthy and newsworthy is when it actually hits risk trends. Now, when I measure risk trends from this particular theme, I like to use your standards, your S&P 500 and your volatility index, the VIX. All right. Now you can see that the S&P 500 we've already aligned to these very important dates, but we've also aligned some very important dates to the VIX. All right. it's noteworthy that the S&P 500 is at record highs. The VIX is at multi-year lows, approximately 6 or 7 year lows. So there is a very big contrast between these two, and it's very easy to tip this off. I won't go to the chart, but I bring it up pretty often. There's a record amount of leverage, and people are exposed to exceptionally risky assets. Right? Still a lot of open exposure into high yield assets that are richly priced. So there is some very sensitive, very open market to respond to these kind of changes in sentiment, but we need to see that change in sentiment. And these are two of the best benchmarks for measuring this because they are so extraordinarily positioned at extremes. S&P 500 record highs, S&P 500, the VIX at exceptionally low levels. All right, they are at extremes that aren't what I would call natural. All right, so risk implications are very clear. All right, once we start to see the risk theme pick up, the S&P 500 obviously is very exposed to a possible correction to the downside, and then we start to cater to the safe haven appeal of the U.S. dollar, something that has been really pushed to the backdrop for a long time. This is what a lot of people are waiting for because it's the easiest shotgun effect fundamental measure to actually gauge from this. We can get a lot of traction on yen crosses as well. The yen crosses are likely to drop off on that kind of theme. But remember, this theme, this risk appetite based move, requires that this taper consideration really really bore itself into the market, right? That is an extreme influence, and we haven't got there yet. We'll likely see a steady upgrade, and it wouldn't surprise me at all if the financial press applies the reasoning, the responsibility of such a move on risk themes, not to this important shift in underlying fundamentals, but more so of whatever happens to be the catalyst of the day. All right, and it's a misplacement of responsibility because this is a very important theme. It just needs to be met with the right catalysts. So we'll watch this, but remember, this is an extreme influence. That doesn't mean necessarily that you can't trade it. One of the best measures for the influence of monetary policy is not just the dollar, but seeing how the dollar under the regime of a taper is doing against counterparts that might be doing something differently. All right, we'll start with the euro. The euro is perhaps one of the lower end, and we'll go up the scale. But the ECB has recently cut rates back in November. There's some discussion about whether they will upgrade their stimulus program to more stimulus like a LTRO program or something that is more targeted. If you want to, I'll speak about this more in depth in today's trading video, so if you want to learn more about that, go there. But this is a significant deviation in path. The ECB is talking about the possibility of more stimulus. The Fed is talking about pulling down stimulus. All right. So this is a theme that will help to push this potentially lower. Look at what happened to the euro dollar when the Fed deferred taper. All right. Dollar drops, euro rises. All right. That's back when the ECB was still stock still. When they introduced the possibility of actually the time frame of a taper back in June, dollar rallies, euro drops. All right. Now we had that taper and the dollar was down, but it really didn't gain much traction. It will gain traction, however, especially if the ECB clarifies its bearings towards more stimulus. Let's upgrade this. The dollar versus the yen. All right, the Fed tapering versus the Bank of Japan likely heading into its second stimulus program. This expectation is already well ingrained. We can see it playing through very nicely here. All right. You can see what happened when the Fed upgraded it, or it gave the time frame. Big rally for the dollar yen. Moderate response when the actual taper deferment actually occurred back in September. All right. So it was the Japanese depreciation on the expectations that the Bank of Japan is going to actually increase the stimulus that helped neutralize that negative dollar influence. All right. Now we have further, we have the actual taper, and this is going to continue pushing higher. It's a little bit mature though. All right, we've already seen a lot of this priced in, and we're exceptionally exposed to any kind of risk themes because dollar yen will pull back in a risk aversion scenario. And then finally, one of the most overexposed pairs, but not many people consider it as such, the pound dollar. All right, we know what the dollar side of this story is, but the pound has risen aggressively on expectations that the Bank of England will hike rates sometime within this year. Right? That is far too aggressive and something that's probably going to be downgraded. All right? If it is, all right, I'm not going to try to preempt that, but if it is downgraded, if we see data undermine expectations of a 2014 rate hike, it doesn't have to change the Bank of England tune. They've been pretty consistent throughout. But if it changes the market's expectations, the pound will start to come back, and the Fed, new in its monetary policy bearings, will start to really leverage this pair to the downside under its own accord. Okay, so this has very broad implications, the Fed's taper and monetary policy bearings, and a lot of people get confused because their primary source of measuring this is just looking at the dollar and the S&P 500. But you have to look a little bit further into it because those two assets have very prevailing trends, and they have, in the dollar's case, something on the opposite side. The currency it's priced in or priced against that can weigh down the influence of this particular theme. When this theme builds momentum, it will be something that stands out more aggressively, whether through risk trends or a rise in U.S. interest rates. But in the meantime, there's still something to trade there. And the momentum, the swings in price will become more exceptional, but a lot of us are just writing it off because we're not seeing the huge S&P 500 drop or the huge dollar rally. That'd be a fallacy. Right? There's a lot behind there, and there's a lot more to come. So we have to look at these various places to measure how it's doing going forward. All right, so hopefully that helps you out with this particular very important theme. It will be a top theme, not just U.S. monetary policy, but relative monetary policy in 2014. So apply this really everywhere. There's a lot here that you can use in placing your fundamental trades. Hopefully this helps you. We'll do another strategy video tomorrow. In the meantime, good luck trading out there.